Hello traders, and welcome to another exciting episode of Forexer. In today's episode, we're going to explore our exclusive liquidity sweep trading plan, which has the potential to revolutionize your approach to the market. We will delve into the intriguing realm of exclusive liquidity sweep patterns. This strategy has the power to significantly boost your win rates. But we won't stop there. In this video, we will go beyond theory, guiding you through each step with precision. We will break down the exact entry and exit points, eliminating any confusion or uncertainty. You will have a strategic roadmap to success. By the end of this tutorial, you'll be equipped with a strategic powerhouse that has the potential to reshape your trading career. So traders, if this interests you, please give this video a thumbs up to show your support and subscribe to our channel. Let's get started. This advanced trading strategy comprises three fundamental instructions that we must adhere to. Firstly, it is crucial to identify a valid single candle liquidity sweep pattern on the higher time frame. Moving on to the second step, we shift to a lower time frame to gain a clearer perspective on the price action and look for any indications of a change in market behavior. Once we confirm the shift in market structure on the lower time frame, we proceed to the third step, which involves setting up our entry. Now that we have a general outline of the core steps involved in this advanced trading strategy, let's dive into the details of each step, beginning with how to accurately identify a valid single candle liquidity sweep pattern in the market. In a bearish scenario, the bearish liquidity sweep pattern is formed by a single candle that clears out the liquidity above the previous high, including sweeping the high of the preceding candle. This specific pattern typically occurs just before a rapid and substantial downward shift in the market. To identify it, we search for a liquidity sweep characterized by a long wick or body, followed by an immediate and sharp downward price movement. It is crucial that the price sweeps the liquidity above the highest point of the previous structure using only one candle body or wick. Furthermore, the subsequent candle's body or wick should not exceed or close higher than the first candle's body or wick. We aim to witness an immediate reversal in price direction, with the price returning to the range below the high after the liquidity sweep. This rapid reversal is a key characteristic of the bearish liquidity sweep pattern. In the bullish scenario, the bearish liquidity sweep pattern refers to a single candle that clears the liquidity below the previous low, including the previous candle's low. This pattern typically occurs just before a significant upward movement. We search for a liquidity sweep characterized by a long wick or body, followed by an immediate upward push in price. After the liquidity sweep, we expect the price to return to the range above the low. This rapid reversal in price direction is a key feature of the bullish liquidity sweep pattern. A bullish single candle liquidity sweep is considered valid when the price action clears the liquidity below the previous low using a single candle's body or wick. It's crucial that a second candle's body or wick does not form or close lower than the first candle's body or wick. This condition indicates a strong upward momentum and reinforces the bullish potential of the pattern. Before we proceed to analyze real trading examples and see how we can apply the steps of this strategy on a real price chart, it's important to understand and adhere to these criteria for a valid bullish liquidity sweep pattern. Let's take a brief pause to understand the psychology behind this strategy. This will help us establish a solid understanding of how price movement occurs in the market. To illustrate this concept, let's suppose we have structures like this to simulate price movement. In this structure, we can observe that the price initially experiences an upward movement, breaking previous structures to the upside and creating bullish bias. Additionally, it forms demand zones, each with the potential to reverse the price direction upon its approach. Following the sweeping of external liquidity, the price changes its direction to access internal liquidity, aiming to fill the gaps left unfilled. As a result, we see the price pushing downwards and reaching the upper demand zone, forming a minor upward reaction attributed to buying pressure from traders entering long positions. This minor pullback induces more traders to enter the market with long positions, placing their stop losses below the demand zone. This collective activity creates a well-defined liquidity zone just below the inducement zone, waiting for the market to sweep it. Traders who have placed their stop losses within this liquidity zone are providing potential fuel for the market's momentum. In the subsequent development, the price pushes lower and successfully sweeps the liquidity below the recent low with a valid bullish liquidity sweep pattern, using a single candle's body or wick, followed by an immediate push in price to the upside and then returning to the range above the low. after clearing the liquidity. So why do we consider this pattern a high probability setup? We do so because in this scenario, the liquidity below the recent low has already been swept, triggering many stop losses and leading to a sharp increase in buying pressure. Additionally, the price shows significant upward momentum, indicating a strong bullish bias. Furthermore, there is no significant liquidity pool below this zone due to the earlier scenarios. What's the core mindset behind this strategy? The core psychological principle driving this strategy is that when sell-side liquidity is cleared through a liquidity sweep, the price is drawn towards the buy-side liquidity aligned with its prevailing direction. A liquidity sweep on one side often triggers a shift in market sentiment, with traders inclined to follow the momentum and seek opportunities on the side where liquidity hasn't been swept yet. This strategy aims to exploit this psychological behavior by leveraging the dynamics between liquidity zones to identify potential trade setups with favorable risk. Reward ratios. Now, if we shift our attention to a lower section of the screen, we encounter an order block located at the extreme. The question arises, will the price head towards the extreme demand zone or reverse after creating a confirmed bullish liquidity pattern? Notably, in this scenario, you don't have to wait for the price to reach the extreme order block before entering the market. Many traders make the mistake of waiting for the price to reach this extreme order block, expecting it to mitigate extreme demand. However, in this scenario, the price ignores the lower order block and instead creates a bullish liquidity sweep pattern showing a change of character on the lower time frame and sharply moving back to the upside. Traders who wait for the price to come back down and mitigate the extreme demand often miss the trade opportunity. It's crucial to note that this unique trading setup doesn't require waiting for price mitigation of any order block or demand and supply zones. In this approach, trades are executed promptly as soon as valid bullish or bearish liquidity sweep patterns are recognized in the market. Now that we have identified a valid bullish liquidity sweep pattern, our next step is to shift to the lower time frame. Here, we closely monitor the price movement and patiently await the formation of a valid change of character pattern. After detecting the confirmation of a market structure shift on the entry time frame, we can set our entry position on the newly recognized order block. In this case, it's a demand zone on the lower time frame, which is created by the change of character's weight. Alternatively, we can set our entry position on the fair value gaps attributed to the change of character's rally wave. The decision between these entry models is entirely up to you. However, I strongly advise conducting a backtest over a minimum of 6 months in the market before implementing any of these entry strategies. This way, you can assess which model yields superior outcomes and make an informed decision based on empirical data. When these conditions align and we have identified a valid bullish liquidity sweep pattern, along with a confirmed change of character pattern on the lower time frame, we consider a long trading opportunity. Our target for this trade is set at the external liquidity level, which serves as the take-profit level. This approach helps us define our entry and exit points with precision to optimize our trading strategy. Furthermore, if the price fails to make any bullish movement and it's our stop loss, our attention shifts to the order block situated at the extreme. This order block becomes our high probability demand zone for a buying opportunity. The rationale behind this is that the price has already used the upper demand zone as an inducement area, successfully sweeping the substantial liquidity accumulated below that zone. This liquidity primarily comes from the stop-loss orders of traders who entered the market aggressively with long positions. Our next step is to patiently wait for the price to reach the extreme order block. Once it reaches this level, we can consider entering a long position after the creation of a valid change of character pattern on the lower time frame. Now that we have a solid understanding of how single candle liquidity sweep patterns can be utilized in our trading plan to enhance profitability, and also have detailed instructions about how to set up entries based on the strategy, it's time to move into real chart examples. This will help us apply these concepts in practical trading scenarios. Here, we have the Euro-Dollar 1-hour time frame displayed on the screen. As you can see, the price is in a strong downtrend and has also created several breaks of structures to the downside. If we zoom into the 15-minute time frame, we can see that the price sharply cleared the liquidity above this high with a long wick. Following this, the price immediately reversed and closed below the highs range, creating a valid bearish liquidity sweep pattern. This pattern is a clear example of how the concept of liquidity sweep is applied in real-time trading analysis. Having identified a valid liquidity sweep pattern in the 15-minute time frame, our next course of action was to zoom into the 1-minute time frame price chart and patiently wait for the price to form a change of character pattern. Here, we have the 1-minute time frame chart, and as you can see, the price created a perfect change of character by breaking and closing below this structure to the downside, leaving behind an incredible inefficiency. Moving on to the next step, we highlighted the order blocks created by the change in the character's wave. Upon closer inspection, it becomes evident that 2 order blocks have been formed by the change of character's wave, and both of them have the potential to change the price direction. To avoid missing out on this exceptional trading opportunity, a cautious approach is adopted. This involves placing sell limit orders at the lowest points of both order blocks to ensure risk management. The stop loss is set a few pips above the highest point of the order blocks. As for the take profit targets, they are set at this recent swing low, anticipating that the price will move in that direction. With the sell limit orders placed, we observe how the market reacts and whether our trade setups play out successfully. As the trade progresses, we can see that the price initiates a downward movement once our initial sell limit order is executed. It's clear that after addressing the lower order block, the price shifts its direction to the downside. Furthermore, the price continues to decline without triggering the extreme sell order. Eventually, the price reaches our preset take profit target, resulting in a trade that yielded a promising reward to risk ratio and demonstrating a successful outcome. Now, let's proceed to examine another example. Once more, we have the Euro/Dollar 15-minute time frame chart. If we take a closer look at the chart, we can see that the price has cleared the liquidity above this structure with a single candle, followed by an immediate push in price to the downside. The price then returns to the range below the previous high, pinpointing a valid liquidity sweep pattern. With the identification of a valid liquidity sweep pattern, let's zoom into the 1-minute time frame to obtain a clearer view of price action and search for any signs of a change of character pattern. This step is crucial as it allows us to confirm the shift in market structure and consider our potential entry position. Shifting our focus to the 1-minute time frame chart, we observe that the price has created a change of character by breaking and closing below this structure to the downside, leaving behind a significant inefficiency. In the subsequent phase, we identify the order block generated by the change of character's rally wave. Additionally, we spot a fair value gap positioned just below the order block. Now, the crucial question arises: which zone should we prioritize for positioning our sell limit order? Should our order be grounded in the order block, or should we focus on the fair value gaps? To answer this query, let me explain my entry approach in situations like these within the market. When faced with scenarios where order blocks and fair value gaps coincide, my preference is to position my entry point at the midpoint of the zone, which includes both the order block and fair value gaps. This strategy offers the advantage of an optimized entry point and a narrower stop loss. It also reduces the likelihood of trade losses, as there's a chance that after filling the fair value gaps, the price might reverse and move downward without engaging the order block. Placing a sell limit order solely on the order block could result in missing out on a prime trading opportunity. Now, I'm about to position a sell limit order right in the middle of this zone. To maintain a strong risk management strategy, I'll also place the stop loss a few pips above the zone's highest point. My focus for the take profit target is set on this particular swing low, as it presents a significant level where we expect the price to potentially reach. Now, we must monitor the market closely and let the trade unfold according to our analysis. Our sell order has been activated and we are officially in the market. As anticipated, the price moved downward after the activation of the sell limit order, eventually reaching our take profit target. However, as evident from this example, if we had chosen to enter the market using the order block located at the extreme end, we would have missed out on this exceptional trading opportunity. If we had solely relied on placing our entry and exit points based on the fair value gap, it's obvious that our stop loss would have been triggered by the price movement. As I highlighted earlier, it's crucial to conduct thorough backtesting of these entry methods across various currency pairs in different kill zones. This way, you can determine which entry approach aligns best with your trading plan, considering factors such as your trading psychology and approach. That's it, traders. Remember that trading is not just about making profits, but also about managing risks and being disciplined. It takes time and practice to become a successful trader, so don't get discouraged by losses and always keep learning and improving your skills. Keep up the good work, and I wish you all the best in your trading journey. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you'd like us to cover in our future videos. We appreciate your support and look forward to seeing you in the next episode.